Commercial property investing can be complex, so understanding some of the key terms we use in the industry may be helpful when considering an investment into Australian commercial real estate. So today I'm going to take you through some of the most common terms and explain what they mean. So let's kick it off today with AREIT, which stands for Australian Real Estate Investment Trust, and it's simply a vehicle that owns a portfolio of property assets which are listed on the Australian Stock Exchange, or ASX. They're an alternate to direct property investment and can be used to provide portfolio diversification. An AREIT is diversified and professionally managed and typically a portfolio of real estate assets that enables investors to access commercial, industrial, retail, social infrastructure, service stations, or a mix of these real estate sectors which are not typically available to an individual investor. REITs may either invest in property locally in Australia or internationally, and investors can gain the benefit of any increase in value in the underlying assets and from regular rental income generated from the properties owned. A key advantage of an AREIT is that because it is traded daily on the ASX, it is typically a liquid investment. Acquisition costs are the total costs incurred of acquiring an asset. This may include stamp duty, legal and consultant fees, valuation fees, and any other due diligence costs related to the acquisition of the property. But stamp duty is by far the largest cost, and it works for commercial property in a similar way as it does for residential property. That is, depending on the state, you're typically up for between 5 and 6% of the valuation of the asset in stamp duty costs. Frequently used in the real estate industry, the cap rate, which is simply short for capitalisation rate, is one of the measures of the expected return of an asset. Expressed as a percentage, cap rates are calculated by dividing the net property income of an asset by the market price for the property, or in the case of an acquisition, the acquisition price. So if a property was worth $100 million and it was providing $5 million of net property income, the capitalisation rate would be 5%. A direct property fund is where multiple investors' money is pooled together to purchase property assets. Ownership is shared between investors based on their investment portion, with ownership divided into units in the fund. But the actual investment decisions and what specific property to acquire or sell is ultimately determined by a professional fund manager. Direct property funds generally comprise of a number of assets, creating asset and tenant diversification for investors. Distributions are regular income payments made from the fund to investors. Generally, distributions will be made to investors on either a monthly or quarterly basis, and that's how it works for our Charter Hall unlisted funds. DRP stands for Distribution Reinvestment Plan and is the opportunity to reinvest distributions by purchasing additional units. Often, the reinvestment of the distributions comes with the advantage of being able to obtain units at a discounted price. This happens by way of reducing the unit price for the new units, meaning investors are issued more units for a given sum of capital. Effective rents are rental payments less landlord concessions or tenant incentives that are provided. Gearing generally refers to the use of debt to fund investment activities. Gearing amplifies gains and losses in the fund, and higher levels of gearing are associated with higher levels of risk. At Charter Hall, we believe it is ideal to have long-term gearing in the range of 25 to 40%. GLA stands for Gross Lettable Area and is a total amount of space available to be rented. GLA usually applies to industrial and logistics as well as retail properties. ICR. Now this one's a little bit trickier because it does stand for two completely different and unrelated topics. The first one I'll talk to is ICR interest cover ratio. In this instance, ICR measures the ability of a fund to meet its interest payments on debt finance out of its earnings. The level of interest cover gives an indication of a fund's financial health in paying both interest to debt finance providers as well as having enough left over for distributions to investors. The second one is indirect cost ratio ICR, and it is similar to the investment fee. In this case, the ICR represents the estimated costs related to the management of assets for that particular investment option. An initial yield is the annualized property income expressed as a percentage of the property value. LVR stands for loan to value ratio and is a method of determining borrowing capacity and leverage. It's usually expressed as a percentage. So if you had a 40% LVR, it would mean that if your property was worth 100 million, you could borrow up to a maximum of $40 million. NABERS, which stands for National Australian Building Energy Rating Scheme, and it provides a reliable and comparable sustainability measurement for properties across various sectors. NABERS ratings are something that Charter Hall has been focused on for a very long time because we're always looking to improve the environmental ratings of the assets that the funds own. NLA stands for Net Lettable Area and is the total amount of floor space available to be rented. NLA usually applies to office property, whereas the previously described GLA relates to industrial and logistics properties. Net operating income, or NOI, is the annual gross income received on a property after deducting all operating and statutory expenses. Occupancy refers to the extent that a building is full and whether the building has tenants and how much of the building is leased. It's most commonly measured as a percentage of the occupied floor space to total space in the property, but can also be done as a percentage of the net income in the property versus the total income expected from the property. Commercial property performance benefits greatly from high levels of occupancy. Higher levels of occupancy mean greater income that can be distributed to investors that own the property. A product disclosure statement, or PDS for short, is a document that contains key information about an investment product, including a direct property fund. A PDS provides an overview of the investment as well as outline the benefits as well as risks that should be considered. It will include the costs of the financial product and any other fees associated with it. If you see something as being tax deferred, this refers to the possibility of paying tax in a different financial year to the one in which income is distributed. A triple net lease, referred to as triple net or 3 Ns, is a lease agreement whereby the tenant pays all the expenses of the property, including real estate taxes, building insurance, and repairs and maintenance. These expenses are in addition to the cost of the rent that the tenant pays. It is a great lease structure to have if you're a landlord, and it's something we actively seek out at Charter Hall. The vacancy rate refers to the extent that a property is vacant or how much of the building is not leased. It's the exact opposite of the occupancy rate. A low vacancy rate is good because it means that the property is providing more income that is available to be distributed to the fund's investors. Valuation refers to the value of a property, and it's usually calculated by an independent and registered valuation professional. The valuer will use a combination of discounted cash flow, capitalisation rate, and direct comparison techniques to ultimately arrive at a fair market price. It is the price that is assumed that a willing buyer and willing seller would transact the property at. At Charter Hall, we typically have all our properties independently valued every 6 months or more frequently if required. WALE, or weighted average lease expiry, refers to the average contractual and legally binding lease expiry between 2 or more tenants. A high WALE means tenants on average have committed for longer periods of time in the building or portfolio of properties. The weighting of WALE is calculated based on the amount of floor space a tenant occupies, or the income they're generating, or the relative valuation of the assets in the property portfolio. At Charter Hall, WALE is something we very much focus on. It means we have greater level of income security, meaning we have reliability of the income and ultimately distributions which we pay to our investors. Yield is simply income divided by an investment's value. For investors in property funds, the income yield is often quoted by a manager. It is the value of the annual income distributions paid by the fund divided by the unit price at a point in time. For example, if a fund had a $1.50 unit price and was paying an annual distribution of 9 cents, it would have a distribution yield of 6%, being 9 cents divided by the $1.50. So these are just some of the many pieces of financial jargon you'll come across in relation to commercial property. I really hope that this short video was beneficial to your understanding of the sector, and thank you very much for joining me.